Hello everyone and welcome back to my channel. In this new video, I'm going to show you how to analyze the higher time frame charts using ICT concepts. This means understanding how to predict the next liquidity draw or determining where the price is attempting to reach. Today's lesson is universal and not specific to any particular strategy. Whether you are using the silver bullet, the 2022 model, the 30-second model, or even retail approaches, it doesn't matter. What I'm about to share with you applies to everything. After understanding the monthly or weekly expansion, your strategy's win rate will increase dramatically, and I'll prove this to you later on as I summarize a year of studying the higher time frames in this single video. I promise you guys that investing time to understand and study the higher time frames is a huge step towards profitability and becoming a consistent trader. So, if you are interested, then stick around till the end and don't forget to hit that like button and subscribe to my channel so you won't miss any upcoming videos. And let's get started. Now guys, before we start the actual video and showing you how to analyze the higher time frame, I want to give you an important advice. This advice will help you a lot in analyzing the higher time frame or even the lower time frame, and overall it will help you to step up your game in trading. Now let's suppose you have, you have like 30 pairs, right? 30 Forex pairs, you have indices, you have commodities, energies, right? Now what I want you to do, after of course learning the lesson from today, when you open the chart, right, and you can't figure out the next draw liquidity in the first 10 or 15 seconds, I want you to move on to another pair. Alright, do not try to force anything, guys. Alright, if it's not clear, if it's not easy to spot, don't force it and move on. Abandon that pair. Now, I'm not saying that that pair is not tradable. No, I'm saying why would you choose something is complex or hard to determine? Why do you have much easier pairs to trade? Guys, this is not a competition or a contest. You need to trade smart, alright? And the reason I'm saying this, because when I shared on my latest video, I believe it was a trade breakdown on Chef GPY pair, right? And of course, I took you from the higher time frame all the way to the lower time frame and gave you my thought process. And some of you commented on my video and said, alright, but this is easy narrative, right? The higher time frame is so easy to determine or to analyze. Can you give us more complex narratives? And I was like, I replied to him, but why would you choose more complex narratives? You have 30 pairs, man. You have gold, you have indices. Why would you choose complex narratives when you have easier ones? And guys, if you apply this advice to your trading, and I don't care what strategy you are using, if you followed the easy narratives when the chart is speaking to you, I'm going there, man, alright? I'm going to that level. It's clear as daylight. That's the pair that you want to trade, alright? And guys, applying this to my trading increased my win rate to levels I didn't even imagine I could reach. So anyways, I wanted to clear that up, and now let's move on to how to actually analyze the higher time frames. Now, I told you that you have a lot of pairs to choose from. You have commodities, you have indices, and the question is, how do you choose which pair to trade? So you need to choose a high probability pair or environment or conditions to trade in. So first of all, before going further with the analysis, I'm going to show you exactly how to determine whether this pair is a high probability or not, and whether you continue with the analysis on the higher time frame and the lower time frame, or move on to another pair. So I remember ICT once said, I really can't determine whether it was on a mentorship or on his Twitter account, but I remember him saying, if you can frame both sides of the market, then you need to step aside. If you can frame both sides of the market, you need to step aside. Now, what does he mean by that? What do we mean by framing both sides of the market? Suppose we are here, right? We are on this point right here. The first thing that you need to do is frame the sell side. So let's see if price can go all the way to here. So from this point, right? So this move to the downside. Can we frame it? Do we have a reason to go to the downside? So let's analyze. What do we have here? Price, and remember that price do only two things. It takes liquidity from all highs and all lows and balancing imbalances, right? So here the market took major sell side liquidity, this swing right here and this swing. So we have filled swings, and we have also tapped into this monthly order block, this candle right here. And if we go to the weekly, you can clearly see this refined order block, right? This candle. And after tapping to it, it formed a major swing low on the monthly. So is there a reason for price to go to here? Can we frame this move to here? No, there's absolutely no reason for price to reverse and go all the way to here, right? Maybe there is a chance of 20% or 10%, but we don't capitalize on those moves. Now let's move on. So now let's try to frame a move to the upside. Can we do that? Do we have a reason to go to the upside? Yes. Why? We have this major pool of liquidity right here. We have also this pool of liquidity, and we have also this rejection block right here. Why did I choose this and not this high? Because when you see a long wick right here on either a swing high or a swing low, you will notice that the volume or the bulk of the volume is just above the bodies of the candles, not here. So you can see that we can frame a move to the upside, but we can't really frame a move to the downside. So this is a one-sided market, and you want to choose this kind of pairs where one move is more probable than the other move. It's more logical than the opposite move. Now let me show you an example of a pair that we can frame both sides of the market. So as you can see here, we have the AUD against the Japanese yen. Now let's try to frame both sides of the market. Can we go to the downside right here? Can we go to here? Yes, we can. Why? We have this filled swings right here, right? So we have this pool of liquidity, and price can easily go all the way to here and take it and then continue to the upside. Now, can we frame a move to the upside? Yes, we also have this filled swings right here. We have this pool of liquidity, right? So price can easily go to the upside. Let's go to the weekly and see more things clearly. Let's move on to the daily. So on the daily, what do we have? We are here, right? Can we move to the downside? Yes, we have also this filled swings, right? On the upside, we have also filled swings. So on both sides of the market, we have major pool of liquidity. And as you can see, the fair value gaps are not being respected. We have this fair value gap that turned into an inverted. It respected it here. We have also this fair value gap that we are moving through it multiple times. So this is low probability conditions, and we no longer intersect in this pair. Again, when you can frame both sides of the market, you need to move on, guys. You need to move to another pair and choose it. Don't force anything. Don't try to go to the lower time frames. If the higher time frame is not clear, move on, dude. There's a lot of pairs out there that are easier to trade. Now, I'm not saying these pairs are not tradable. I'm not saying that, but I'm saying that while you have much easier pairs to trade, why do we choose this? There's no point of choosing this, all right? So that's the first thing you do. You need to frame both sides of the market. If you can frame both sides of the market, you need to move on, and that pair is no longer high probability, right? If you can frame only one side, only one move, either to the upside or downside, now we can continue on how exactly we can analyze the higher time frame to figure out the drawn liquidity. All right, so let's move on. So in order to analyze the higher time frame, we need to ask ourselves two main questions. Only two main questions. The first question is, where is the price coming from? So the point of origin. This leg right here, where is it coming from? The second question is, where is the price trying to reach? All right, so the target, the source and the target. Let's look at this structure right here, and this is the US dollar against the Canadian dollar, the monthly time frame. When you analyze the higher time frame, you're going to choose the monthly, weekly and the daily. Sometimes the 4 hour, but I prefer daily and above. So this leg right here, or is the origin from it? We have this order block, this monthly order block, right? And we have also took major liquidity, major sell side liquidity from here. We have also took liquidity from this candle, took liquidity from last week low. As you can see, we formed a major swing low, this 3 candle formation. So this is the point of origin, right? And always remember, price does only 2 things: balancing imbalances and attacking buy side and sell side liquidity. So on the upside, so on the downside, we have took liquidity. We don't have really much of imbalances in this structure right here, so we're gonna only use external raise liquidity, so swing highs and swing lows as pool of liquidity, right? So price has finished its business on the downside, took liquidity from here, tapped into this order block also on the weekly, and this is the first question, right? We answered the first question. The second question is where the price is trying to reach for, and we can see that we have 2 filled swings right here. So we have a lot of liquidity. We have a pull of liquidity from here. This is the first drawn liquidity. This is the second drawn liquidity, and these are obvious, and I'm pretty sure we're going to reach those in the future, right? And we have also this rejection block. We have a lot of liquidity residing above the bodies of the candles right here. So we answered these 2 questions, and now we have the buys of longs, right? So how you're going to approach this information, this precious information of the higher time frame in your lower time frame entries? Suppose you have a strategy, right? It doesn't matter. Maybe it has a 40% win rate, 30% win rate, 50, 60% win rate. And I believe you take longs and shorts on the strategy, so you buy and sell. Now, what I want you to do is to take only longs. On this pair, you can apply the strategy of yours on this pair and take only longs. Don't try to take sells, only longs on this pair. Now, of course, you're not going to get that many setups a week or a month, but the win rate, I'm 100% sure that the win rate will increase. When you take only longs, you will notice that your TP is going to get hit easily, right? You will not face that many consolidations. Price will not struggle to reach to higher levels. This is the reason that I'm not a fan of trading only 1 pair or 2 pairs. When you trade only 1 pair, you need to take trades on both sides of the market, so sells and buys. But when you have 5 pairs or 6 pairs on your watch list, and let's say, for example, 3 of them are going to the downside on the higher time frame, and 2 of them are bullish on the higher time frame, and you're going to take only longs on the bullish higher time frame and shorts on the bearish higher time frame, then you will have such a high win rate, and you will get in and get out in a matter of minutes. Believe me. And to prove that to you, you can go to your journal, right, and filter the trades that were aligned with the higher time frame direction, and you will see that your win rate will be increased, right, and your profits also will be much bigger than it is right now. So let's move on to the weekly chart, and let's apply the same logic. So what do we have on the weekly chart? We are on this point right here. Now let's try to apply again the same approach, right? We are on this point. Now, can we frame a move to the downside, right? To this point right here, to this swing? It is unlikely. Why? We have this fair value gap, so price is reacting from a weekly fair value gap. When it reached that, it formed what? A major swing low. We have also this inverted fair value gap right here. So price is finding support on 2 PD arrays, right? So as you can see that the bodies of the candles stayed in within this inverted fair value gap, and the wicks balanced this fair value gap right here. We have also retraced to discount, right? So a move to here is unlikely. Price, I'm not saying that it is impossible, but it is unlikely. We trade with probabilities. Now, can we frame a move to the upside? Yes. Again, we have this pool of liquidity right here. We have also this pool of liquidity and that monthly rejection block. So price can go to the upside. Again, this is high probability trading conditions. And we are also reacting from this order block. And again, you can ask the two questions. Where is the price coming from? It is coming from this weekly fair value gap, right? And this inverted fair value gap also, right? Also have this breaker block. And where is the price trying to reach for? This pool of liquidities right here. So now you can go to the lower time frames and take only long positions. Or if you want, you can maybe use half the risk on retracements. So move to the downside, you can use half the risk, and you can use full risk when you have a trade or a setup that is aligned with the higher time frame. And now let's move on to more examples so you can really understand this approach. Now the second example is the British pound against the New Zealand dollar, and this is the weekly chart. So we are here on this point right here. Can we frame a move to the downside? Is it logical for price from here to just continue to the downside? No. Why? We have tapped into this weekly fair value gap, right? Balanced this fair value gap. We have taken major swing low right here. So external range liquidity. We swept this sell side liquidity. We have also tapped into a monthly order blocks on this right here. If we go to the monthly, we will clearly see it as an order block. So as you can see on the downside, we have done three things. Tapped into this order block, balanced this imbalance, took sell side of liquidity. So is it logical for price to go again to here? No, it is not. It is not probable for price to go all the way to here. So we can't really frame a move to the downside. Now, can we frame a move to the upside? Yes, we have this special leg right here, right? It left a lot of imbalances. And you can see here, we have also this equal highs, so bullish liquidity. And also we are on discount. So on the dealing range from here to here, we are on deep discount. So at least we need to retrace to premium. So there is a reason for price to go to the upside. And as you can see here, price immediately went to the upside. So this is the weekly chart, and imagine you took only longs on these days. So this is high probability condition. And now let's move on to another pair. The third example is the US dollar index, and this is the monthly chart. And as you can see, it is pretty similar to the GBP against the New Zealand dollar. Price from here, from this point, right? Can we frame a move to the downside again? Can we frame it? No, we can't. We tapped into this fair value gap, this monthly fair value gap, and we have also a sweep on liquidity right here. So this is high probability sweep. We took sell side, we imbalanced this imbalance. So on the downside, we have done both things, balancing imbalances and attacking liquidity. Now, do we have a reason to go to the upside? Can we frame that move to the upside? Again, yes, we have this pool of liquidity, we have this pool of liquidity, we have this trend line phantom, we have also this major imbalance on the monthly. So this is a high probability condition, right? And you can only look for shorts when you trade against the US dollar, like for example, EU or GEO. And here's the result, right? Price exploded to the upside. Now let me show you a final example so you can see that these things actually work, right? So with the final example, and this is the Swiss franc against the Japanese yen, and this is the 1 hour time frame, but again, price is fragile, and what works on the 1 hour, it works on the monthly or the weekly chart, right? So on this point right here, can we frame a move to the downside to here? No, absolutely not. We can't. Why? We have balanced the 4 hour fair value gap right here. We took liquidity, we swept liquidity from here. We violated this swing. So this is a 1 hour breaker. We have a fair value gap right here, a lot of PDR raise, a lot of resistance, and price has absolutely no business of going all the way to here. Now, can we frame a move to the upside? Yes, we can. We have this market maker buy model in the making, so horizontal consolidation idea, and again, this is a major pool of liquidity, and we can expect a move to here. And now let's see the result. As you can see here, price went straight to that pool of liquidity. So again, we are working with probabilities. I'm not saying that 100% price will go exactly to this point and it will not reverse. It can happen. Price can reverse from here, but we are talking about 10% of the times, right? 90% of the times, price will respect this approach, right? So I believe we have come to the end of this video, guys. If you have any questions, please DM me on my Twitter account or leave a comment down below and I'll answer you as soon as I can. Happy trading and good luck.